Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories that we are following for you in the BNN Bloomberg newsroom. Shares of Lululemon are rallying today. The Canadian apparel company posted profit and revenue in its latest quarter that topped estimates, driven by higher same-store sales as well as growth in international markets. Lulu also raised its full-year revenue outlook and announced CEO Calvin McDonald is stepping down at the end of January. Some analysts see the move as a positive, noting the company has been facing slowing sales. Athabasca Oil is one of the biggest decliners on the TSX after providing a 2026 production outlook that disappointed investors. It's off by about 3.7 right now. The Canadian oil and gas producer expects average production next year of up to 39,000 barrels a day, which fell short of analysts' estimates. Athabasca has also earmarked $273 million for its thermal oil division and will also lower the capital spending budget to Costco is out with its latest results, and the wholesale giant logged higher profit and also saw total revenue jump more than 8%, beating estimates. Same-store sales across Canada, the U.S., and international markets are also higher than expected. Costco says the results were helped by a record-breaking Black Friday for its U.S. e-commerce unit. And taking a look at the markets, an off day for the TSX after record highs yesterday, down by 0.56%. And south of the border, everybody is in the red right now. It looks like it's going to be an off day to end the week. S&P 500 down by more than 1%. Dow Jones off by 0.32, and the NASDAQ down by 1.6. Lululemon stock is rallying today after the CEO announced his intention to step down in January. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, CEO stepping down, and so everybody seems happy.
Everyone seems happy. When the markets opened today, the stock price was up 12%. Canadian-born CEO Calvin McDonald stepping down. He said he will step down at the end of January. He's also going to step down from the board of directors, but he will continue as a senior advisor until the end of March. He's been the CEO of the company since 2018, and some economists today saying that he wasn't really doing the best job when it comes to leading the company, or at least the company wasn't doing so well under his leadership, because it has been struggling over the last couple of years. It dropped more than 50% this year alone. And the company's also been seeing a slowdown in its U.S. sales in particular, as well as just more competition, right? You're seeing Alo Yoga come up. Market. Yeah, Aritzia's TNA brand is back. Nike and Skims partnering for athletic wear. So more competition, a shift in trends away from leisure wear. You know, people a few years ago were maybe wearing a lot of yoga wear outside, just in everyday life. People are going back to jeans. Things are changing. And so now there's a succession plan in place. CFO and Chief Commercial Officer of the company will serve as interim CEOs. That's Megan Frank and Andre Mastrini as they search for a replacement. Okay. And how long, do they know how long that's going to take? They don't know how long that's going to take. The search is already apparently about to be underway. They picked people who are going to head this search. But in the meantime, the company also, like the other reason that we're seeing this stock price just going up today and the company seeming to do well is because it's boosted its outlook for the year. So yesterday they did this, and this comes after the company actually cut its fiscal year guidance twice, lowered its sales guidance once, but now the company actually expecting to see profits in the next couple of years. They expect net revenue to be between $10 to $11 billion. That's a growth rate of about 4 to 6%. And Lulu says this is coming from improved sales internationally as well as sales in Canada. Sales have been ticking up ever so slightly when it comes to Canada over the last couple of quarters. And also the company says it expects higher tariff rates to dent profits by about $210 million. That's compared to previous estimates of $240. So the company not expecting to be hit as hard by tariffs. So good news there. And then, of course, we're just kind of following this news today. There is a lot of reaction to the fact that the CEO is stepping down. We know that Chip Wilson, the founder and former CEO of the company, someone who's been very vocal, very controversial, you could say, in the past, has come out talking about he's also still the largest active shareholder of the company. And he's saying that this only happened after increased pressure from him, because he's been talking about this for months now, about how the company is doing and how they need different leadership. He says the CEO search should be led by new independent directors with relevant expertise. So definitely a lot of opinions after this news.
A little bit of a roller coaster still ahead for him.
Yeah.
All right, Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscaya. Coming up next, there are only 19 days left in the calendar year. Jamie Gollenbeck, tax and estate planning managing director at CIBC Private Wealth, has some year-end tax planning tips. You don't want to miss that conversation. That's next. Well, it is the end of the year, so there's a lot to unpack with year-end tax planning. Of course, some deadlines are approaching, especially December 31st. For more on it, we were joined earlier by Jamie Gollenbeck, tax and estate planning managing director at CIBC Private Wealth.
Well, we always talk about, the end of the year tax loss selling. You have a deadline of December 30th that settle that trade by December 31st. And you would do this, you have, the odd loser in the portfolio. You don't think it's going to bounce back, and you want to be able to use that capital loss against any other gains this year. But it's also your last kick at the can to go back 3 years. So you can take capital loss, apply it against capital gains in the prior 3 calendar years. And so 2022 falls off the table. So I would just take a quick peek at your 2022 tax return. If you reported any capital gains there, maybe now you want to realize that loser before the end of the year, take that loss, carry it back to 2022, and get back any capital gains tax paid in that year.
And how many do you sell? What do you base that decision on when you're looking at your loss at the investments that aren't doing well? Do you hold on to some? Or how do you make that decision?
Yeah, so I think primarily you want to make sure it's an investment decision. In other words, you don't want the sort of the tax to drive it. At the same time, tax could be a consideration. So I'd look at your portfolio and say, these particular stocks, these positions, I think I'm done. I think I could better deploy these assets somewhere else in a different stock or a different position. I can rebalance the portfolio, time to take those losses. In terms of the quantity and quantum of those losses, then you really want to be strategic. Do I have other gains this year, in which case I can get the capital gains tax eliminated? Do I have gains in the prior 3 calendar years? Otherwise, you don't have to sell anything else because losses carry forward indefinitely. So there's no rush to sell things from a tax perspective if you can't use the loss right away. But at the end of the day, I would say make an investment decision first. That should be your primary consideration.
Okay.
Jamie, for some investors, you talk, for high net worth individuals, stuff like that, the idea of, personal holding corporations or things like that are better to hold investments. And what are you thinking as should it be as an individual? Or are there any reasons to, put it in trust or do other forms that are, better defer the gains over a period of time or a better way to take in income as well?
Yeah, well, it's interesting. So there's a number of planning opportunities out there. I mean, the truth is that, if I was setting up a corporation today purely for investment, I probably wouldn't do it because actually investment income is taxed poorly in a corporation in all provinces. The tax rate is effectively higher. But most people, of course, have a business or they have a professional corporation. The money's already in a corporation, in which case it's expensive to take it out. So they do their investing in the corporation. There are some other strategies out there. People have used family trust, for example, on the high net worth side to do some income splitting. You've got to be careful. There's attribution rules there. One of the more popular techniques that we've been promoting over the last number of years with the decline in interest rates is to do what's called a prescribed rate loan, where let's say a parent loans funds to a family trust, charge the minimum 3% rate. Any rate of return above that can then be taxable out to the beneficiaries. Typically, these would be children and other family members. So there are some more sophisticated strategies out there involving family trust. But, for the average person, investing in a non-registered portfolio, to the extent that you've used up all of your RSP and TFSA room, is probably the way to go in a basic non-registered trading account.
All right, and let's talk a little bit about TFSAs. What's the best way to approach those if you've got some room or you might want some money from it?
Yeah, so again, I mean, one of the things we're telling people is between now and the end of the year, if you think that you need to tap into your TFSA for any reason, because TFSAs are a general purpose investment account that you can use for anything from a new car to a new roof or, an emergency fund. The nice thing is that if you need money, let's say earlier next year, take it out this year. And the reason we suggest that is because you're allowed to recontribute any withdrawals beginning the following calendar year. So let's say you need to take $10,000 out in February for some reason. Take it out in December, because if you take it out in December, I'll have it for February. But then should you have some extra cash anytime in 2026, you'll be able to recontribute it immediately back to the TFSA. If on the other hand, you wait till February when you actually need the money and you take the $10,000 out, you're not allowed to recontribute that until the following calendar year, 2027.
I've got another one, Jamie, more as a personal thing, because I turned 70 in January, and I have to roll out of my RSP. Do you suggest most people sort of go into RIF the same way, or annuities, or what are the options? Because I guess if you take it all out, it's all taxable at that point.
Well, that's right. So you have to convert your RSP by the end of the year that you turn 71. And you've got three options. Of course, you can cash it in and pay tax, which no one wants to do. I think rarely do people take that option. The most common option is the RIF. The RIF is a continuation of the RSP, but it's in reverse. A RIF requires you to take out a minimum amount, starting at around 5%, going all the way up to 20%, depending on your age, of the fair value every single year. There's also another option, a registered annuity. Some people do both. They want a guaranteed flow of income, so they'll put part of that money into a registered annuity. But I'd say most of our clients want the flexibility that comes with the RIF that allows them to choose the investments inside that account and then take out the minimum. Of course, you could take out more than minimum, but the minimum amount every single year. And of course, you pay tax on that on an annual basis starting after age 71.
Okay, we're going to go the other way because I'm a young student, unlike John. And let's talk about what should we be aware of for the end of the year for students?
Yeah, so a couple of things. Students, we often recommend the RESP, the Registered Education Savings Plan. Parents want to make sure, grandparents that are topping up $2,500 a year for every single student to get the Canada Education 20% match. That's $500 per year per child in RESP. But I would also say before the end of the year, if the students are already in post-secondary education, you might want to be strategic about RESP withdrawals. The withdrawals, other than the contributions, are taxable to the student. But remember, each student, each individual in Canada gets a basic personal amount, which is over $16,000. So this is an opportunity to withdraw $16,000 of educational assistance payments per student each year to soak up that basic tax credit. So if someone has no other source of income, they don't have a lot of income from either a summer job or a part-time job, in the next couple of weeks of the year, take a look at the student's projected 2025 income, see if there's an opportunity to take out extra money from the RESP that'll help pay for some of their post-secondary education expenses this year.
And that was Jamie Gollenbeck, Tax and Estate Planning Managing Director at CIBC Private Wealth. Coming up, from Pop Marts, Labubu's to Shane, Temu and Luckin, Chinese brands have become global consumer favorites and cultural ambassadors. We'll bring you this week's Bloomberg Doc on the growing power of Chinese brands after this. From Pop Mart's Labubu's to Shein, Temu, and Luckin, Chinese brands have become global consumer favorites and cultural ambassadors, with much of the credit going to TikTok. Shoppers are hungry for more. Bloomberg's weekly doc explores this growing power.
Shoes, phones, windows to alternate realities. Many of our favorite products are made in China, but designed elsewhere. Well, that narrative's beginning to change a bit.
Pop Mart shares rise to a record as the CEO announces a new mini Labubu.
And the Game Award goes to Black Myth Wukong. What we're seeing now is an emergence of Chinese soft power into the rest of the world.
In the past, China was creating all these low-value products, and it's very hard to gain soft power from that. But as you move up the value chain, the natural byproduct is that your soft power also increases.
We will continue to actually see more of them penetrating into various overseas markets.
As the power of China in the global economy has increased, it's an opportunity for them to go and invest in these other markets, similar to the way that American companies probably did in post-war America.
Although no one's saying that's going to be smooth sailing.
A lot of the challenges for Chinese brands, especially in the US, depends a lot on the political uncertainties that have been unfolding under Donald Trump.
Some are locked out of whole markets, while others have invited a certain kind of rhetoric.
The Chinese government has that data.
So with Chinese brands seeming to win over global consumers, could they also help with something much less tangible? Soft power doesn't get much softer than these furry little enigmas. All right, calm down. These things, they're changing perceptions, one screaming child at a time.
You've got people across the world, across the US, on TikTok, unboxing their Labubus, showing off their hauls, from everyday buyer to a major celebrity like Lisa.
Riding that wave of hype has paid off for the brand behind the world's favourite new furry merchandise.
Pop Mart had one store when it opened in Beijing about a decade ago. It's now been able to open across the US, not just on the coast, but in areas of the US heartland like Ohio, and that shows just how far its reach has gone.
Since 2024, Pop Mart's annual revenue has more than tripled.
The overall sales grew as much as 250%.
Addressed the thank you card to TikTok, one of China's other major cultural exports.
TikTok is a really popular app in the US, and it now ranks among the top 5 social media apps, alongside the likes of YouTube, Instagram, Facebook.
The app has over 1 billion users worldwide, including over 170 million per month in the US alone.
And it really brought in a whole generation of young Americans and introduced them to a Chinese brand probably for the first time.
This is a crowd that loves to exclusively browse and buy online, a habit that's already second nature to most Chinese consumers. This chart shows the percentage of people who use apps to shop online and make in-store payments. Compared to the US, for instance, where about 40% of all retail payments are made using phones, Chinese consumers are far ahead.
There has been a generation of Chinese companies that came of age during this mobile-first e-commerce era.
Chinese companies have really had this advantage at home of being able to hone those strategies on these consumers.
And now Chinese companies are bringing that to your morning caffeine.
Luckin became China's biggest coffee brand in 2023, surpassing Starbucks for the first time.
That's in terms of sales revenue, and since then, its lead has only grown. But it's also true in terms of store numbers. As of October 2024, Luckin had 3 times as many stores in China as Starbucks.
In China, it offers drinks for as little as $1, and it's really forced Starbucks to rethink its playbook in the country.
For instance, Luckin customers can only order through a mobile app. That keeps staff and costs down.
And now Luckin's really bringing that fight to the US. It's opened a number of locations in New York, and it's introduced a few items for its fall menu that have pumpkin spice in them. Luckin Coffee is a great example of Chinese companies not only bringing their playbooks to the US, but now starting to adjust what they're doing to accommodate US tastes.
Another place ripe for expansion is here.
Brazil is very similar to China in the sense that you are seeing growing urban centers.
They also had a shift in their demographic to more middle class, so higher ability to spend.
And more importantly, a good part of that population are a lot younger and more willing to actually embrace some of these digital tools into their daily lives.
The retail apps are some of the largest and most popular now in Brazil, specifically Temu and Shein.
and more are looking to join the party.
Meituan, the food delivery business, planning to spend $1 billion over the next 5 years to launch Meituan in Brazil.
This came just as President Lula was visiting Beijing and signed a deal to allow more Chinese investment in mining, transport, and ports. You'll find this mix of government backing and business expansion in other places too.
There is a government push. They have the backing of Beijing to actually go overseas because China would also like to build its global footprint through its companies.
In part, that's because of pressure at home.
China has been going through factory deflation. These companies are facing downward pressure on prices because of intense competition. In order to survive in China, they have to go overseas because that's where they can charge higher prices, get higher profit margins. One of the biggest challenges that Chinese brands are facing now is, of course, the geopolitical uncertainties. We're talking about tariffs, investigations going on into certain sectors.
There is increased scrutiny on data privacy.
Take Huawei, for example. It was blocked from the US over national security concerns. TikTok's faced similar scrutiny, although there has been some softening there.
I like TikTok. That's why they're saying, are you saving? And we probably will save TikTok.
Keep TikTok!
Efforts to save TikTok is evidence of just how entrenched Chinese brands have become, and this familiarity could be shaping people's views. TikTok is popular in youth culture, and a Pew Research Center survey found that people aged 18 to 34 tend to view China more favorably than 35 to 49-year-olds, or the 50-plus crowd.
For an average user, I don't think they see it as a Chinese app or a Chinese retailer. They just think of it as an app.
And that's arguably what soft power is all about. It's meant to be nebulous and unidentifiable. But even if it is working, it's a long road. That same Pew Research data shows most of the countries surveyed still have broadly negative perceptions of China. So the longevity of Chinese brands may depend more on good business strategy than politics.
There are also a lot of questions about sustainability and whether a company like PopMart that's been able to grow this rapidly is going to be able to carry that forward, or whether it's something that's going to see a bubble that will burst.
Retention has become a big issue for JN and Temu. Amazon has 93% retained user rate in the US. Temu is like in the 60% range. So people are pivoting on and off their app.
Despite challenges, Chinese brands are probably here to stay, and this adds to the nation's growing global prominence.
We will continue to actually see a world that is incorporating more Chinese products as well as Chinese-backed services into their daily lives and into their work, with or without them knowing it.
It's a natural transition of the Chinese economy that eventually leads to the cultivation of the soft power as well.
And when we come back, cannabis stocks are up with the expectation that U.S. President Donald Trump will reclassify marijuana cannabis as a less dangerous drug. That's after the break. Shares of cannabis stocks are seeing a surge. Look at those numbers. They're up 32% for Tilray, up 34.3% for Canopy Growth. All this after a report from the Washington Post that U.S. President Donald Trump is expected to push the government to drastically loosen federal restrictions on marijuana. The report says Trump plans to direct agencies to reclassify cannabis as a Schedule III drug. That move would reduce it to the same level as some common prescription painkillers and other drugs. Sales by Canadian wholesalers, excluding petroleum and petroleum products, rose 0.1% to $86 billion in October. Sales rose in 4 of 7 subsectors, representing about half of total wholesale increases. Now, they were led by the motor vehicle and motor vehicle parts and accessories subsector and the farm product subsector. The NASDAQ is proposing a new rule that would allow the exchange to block IPOs even when companies meet all listing standards if it detects red flags that could make a company's stock vulnerable to manipulation. The move underscores a push to tighten gatekeeping as firms from hazy jurisdictions look to tap public markets in the U.S., where a deeper pool of capital often gives companies better valuations than they can get elsewhere. And taking a look at the TSX right now, you can see it's off after approaching record highs. It's down by 0.81%. Technology growth stocks are what's pulling them down right now. And south of the border, similar situation, similar reasons. You can see everybody is in the red down there. S&P 500 off by almost 1.2. There you go, 1.2%. Dow Jones down by 0.56, and the NASDAQ. Fears over AI, over valuations, weighing heavy, off by 1.83%. Now, cannabis stocks are up today, including for Canadian brand High Tide, after U.S. President Donald Trump's administration reportedly said it's expected to reclassify marijuana to a less dangerous drug. Here to talk about it is Vahan Ajamian, capital markets analyst at High Tide. Vahan, thank you very much for joining us.
Of course, thank you for having me.
Your thoughts on what we're hearing today? This is by no means a done deal, but what do you think about it?
Correct. It's by no means a done deal, but it's very, very encouraging. The report by the Washington Post, which you referenced, I think it's if it's enacted, and we'll have to see. The devil's in the details and the timing is particulars, but it could be the biggest federal reform in cannabis in decades. It would be a monumental shift with how Washington, this treats cannabis as an industry and as a medicine.
What opportunities would that present to you if it was changed to a class 3, which essentially would put it in with steroids and Tylenol 3 is another one, and away from heroin and cocaine? What kind of opportunities would that present for you?
Well, for us, it would potentially allow us to go into the United States in a limited way, something we're already looking at with a few different partners. As you mentioned, we're already the largest in Canada with 218 stores across the country and 2.2 million members of our loyalty plan. We've always been interested in getting to the United States, and this is definitely a shift which could allow that down the road. We're having discussions now with a couple of producers in the United States regarding ways that we can tie up with them, whether it be licensing our brand or something of that nature, while still staying compliant with the NASDAQ listings that we have had now for about 4 or 5 years. Our stock trades millions of dollars a day on the NASDAQ, and it's not something that we want to forgo. But there could be ways that we're exploring with multiple partners to be able to get into the United States market in a deeper way than we are today.
And the U.S. market is complicated, isn't it? Because it's very state-driven, especially right now. Do you think that would change if this was pushed through?
It potentially. We'll have to see what exactly when the rescheduling happens and how the market reacts, and whether there's a follow-up decision and action from Congress, potentially to even allow looser banking restrictions. And ultimately, for us, it would be looking at the NASDAQ and what would they allow. Which again, they're taking their cue from the federal landscape. So I think overall it's very, very encouraging. And the whole mentality, I think, from investors, which you can see in the stocks today, including ours, is, there's been years of frustration about inaction from Washington. And that has kept a lot of investors on the sidelines. Now we see for the first time going all the way up to the top, assuming it gets done as reported, going all the way up to the top, an intention, a political will to get reform in the United States to more normalize cannabis, which is really where the public opinion has been for years.
And it's been difficult for investors because I was talking to a friend who had invested at the very beginning and he watched it go up and now he's watched it go down. So there must be some frustration and concern, though, when you're in this one. It's a bit volatile.
For sure. And unfortunately, when you look at companies like High Tide, sometimes I say we suffer from the guilt by association problem. Whether it's Canada and some producers still not making money several years into legalization, that's not our issue. And similar in the United States, the federal inaction has been keeping investors at bay. Finally, it looks like that big wall of frustration is about to come down, which would open up huge opportunities for the U.S. operators. And again, as I mentioned, for us to go down the road once we have a better sense of the future regulatory and framework.
Any indicators on if this process does go ahead, what's next and how long it might take to get to it as a Class 3?
Well, I can't speak to how long it would take for all the reclassification to happen, but just the fact that it's being announced and being pushed at the highest level, that's very, very encouraging. And for us, we'll take our cue from where the political and regulatory landscape comes. So we're already in discussions with a few different producers in the U.S. So we'll be ready to act as soon as we have a better sense of the realities on the ground.
And if
we've always said we want to be a global cannabis player. We just made an acquisition in Germany over the summer of one of the country's leading wholesalers and distributors of medical cannabis, and now we can turn our eyes back to the United States, especially as the macro environment is improving.
And for now, it would still be I assume it would be a medical cannabis only. What kind of market is that in the U.S.?
It's a very large market. Substantially all, if not all, the states have medical programs, and even almost half have adult use programs. So I think it's it's the mentality shift towards normalizing cannabis. And we could potentially be able to play in either of those markets, depending on the structure and partners and the specific rules that will be allowed or not by the NASDAQ.
So what would change if a lot of these states already have medical cannabis? What would change for them with this classification change?
Well, for one big thing is taxation. Right. So right now under Schedule 1, U.S. operators tend to pay 50 to 60% effective tax rates. It's very punitive because you can't deduct your normal SG&A when you're a Schedule 1 substance. So moving into Schedule 3 would allow significantly more normalized tax rates because you can have more proper normal corporate deductions. And then it could increase, so you could benefit on the sort of cash flow side, and it could increase the amount of capital that's available for these firms to get at even more attractive rates and really start turbocharging the overall cannabis industry to levels that we think could be very attractive and economically viable.
Does this feel like this might be a move towards legalizing it completely?
Definitely. It's the first step, assuming it happens. And the momentum and the mentality shifts to, okay, this happened in terms of rescheduling. Now, what happens in terms of safe banking and the ability to have these operators in the United States list on the NASDAQ. Overall, just like we saw in Canada, we had legalization and things sort of got a lot better in terms of the regulations, and they're still happening now here in Canada. The environment is improving. This would be a big signal in the United States that the biggest market in the world is seeing things improve from a regulatory perspective. And obviously legalization on a federal level is sort of the holy grail that we're all eventually anticipating, but it could be a good ride along the way as well.
Okay, we're going to have to wrap it up there, but Vahan, thank you very much for joining us.
Thanks for having me.
Vahan Ajamian is capital markets analyst at High Tide. Coming up, some skeptics think the artificial intelligence data center boom is getting out of hand. Bloomberg's Paula Seligson is here to break it down for us. Two data center billionaires minted before anything is even built. A borrower seeking a loan for 150% of the construction cost, and companies that are using financial engineering to keep liabilities off their balance sheets. For the skeptics, those are some of the examples of why the artificial intelligence data center boom is maybe getting out of hand. For more on this frenzy, we're joined by Bloomberg's Paula Seligson. Paula, thanks very much for joining us.
Thank you for having me.
It almost sounds like some dramatic business soap opera, what is going on when you hear those things thrown around. I have to ask first, who are the billionaires and how did they become billionaires before anything was built?
Well, I think one of the best examples is Fermi, which IPO'd earlier this year. And that's a situation where it popped so much when it IPO'd, the valuation hit 19 billion. It's come back down to earth to around 6 billion today, but they haven't built a data center yet. They haven't built a nuclear power generation facility yet. This is all speculation and expectation it's going to be the next hot thing. So things are getting very frenzied in this space.
And driving this, is debt the big thing here, and what's the concern with it?
Yeah, so when you think about how to build these, yes, a big hyperscaler like a Meta can write a check. Yes, they can use their cash flow, but the need is in the trillions and trillions of dollars in terms of capital expenditures needed to build these data center facilities. You have to turn to the debt markets to do that. But when you turn to debt markets, that means you have to pay back the money at some point. And all of this is predicated on the belief that the revenue will just exponentially increase as the world turns to using AI products. So the more debt you use, the more risk there is that if that revenue doesn't materialize, it can cause problems down the road.
And what's the concern level? I guess DebtCon, is it DebtCon 4, DebtCon 3? What are people starting to be worried? Are they really worried about that, or are they still willing to let it ride?
I think the worry is a little bit in the early stage, and it also depends a lot on the type of debt deal. It's one thing if the debt deal is being ultimately backed by a really large investment grade company, but there are also a lot of things that are happening in the background with smaller companies that don't have, massive existing advertising businesses, for example. So I think on one hand, you have people just absolutely just excited and ready to invest literally hundreds of billions of dollars of debt financing into this space. But then you do have people getting worried, saying like, hey, like, how is this being structured? What is the leverage level? How much equity is being put in versus debt? And if it's not much, why? So I'd say we're still at the early stages of so much of this, including both the frenzy and also the concern.
Now, are we getting any answers to any of those questions that you just raised?
I think the big story that just came out in the last hour, Oracle just had to delay the construction of some of its data centers for OpenAI from 2027 to 2028. Bloomberg broke that news. I think that's kind of an example of what could go wrong, right? Look, it's 1 year. That's not that much in the scheme of things. But in the AI race, 1 year can make a pretty big difference because everyone is trying to beat everyone else to be the first to provide these products, to lock in that customer base. And so if you even see minor delays, that could really cause a problem for some of the financial projections of these companies.
Could people be looking at this as a house of cards, and what might bring it all down?
I think house of cards might be a little bit strong at this point, at least for the lenders who technically they're being backed oftentimes by the value of the data centers themselves. But the key thing that could cause huge problems is if the revenue does not materialize, right? We are all betting that AI is the next big thing. It's the next industrial revolution. And the entire financial industry is essentially investing, assuming it truly is. It is truly transformational. And even if that just ends up being not 100%, but 80% true, or even if it is true, but it takes longer to unfold than people expect, it could cause problems for investors.
All right. Lots of intrigue ahead. Paula, thank you very much for joining us.
Thank you.
Bloomberg's Paula Seligson. It's the last call for Canadians to get their share of the $500 million class action lawsuit that accused George Weston of being part of an industry-wide scheme to fix the price of bread. We got more from CTV's Scott Hurst earlier.
It is your last call to submit a claim for a share of the $500 million bread price-fixing settlement related to the alleged industry-wide price-fixing of packaged bread. So let's walk through the details of what you need to know, what viewers need to know to be able to take part. Anybody in Canada, adults in Canada, can apply. Canadian residents, no proof of purchase is necessary. So no stress trying to find an old grocery receipt. You're eligible if you bought packaged bread for personal use between 2001 and 2021. You just need to file an online claim. There's a separate claim process for Quebec residents. Now, as you pointed out, this stems from the class action lawsuit that accuses Loblaw and its parent company of engaging in an industry-wide scheme to fix the price of bread. The suit alleged that the companies and other big players in the industry engaged in these practices from 2001 for several years, ultimately, Andrew, impacting the price that we paid.
And then what comes next? Is there any timeline on how much money we'll get?
At this point, you can expect to receive compensation within 6 to 12 months, so the money should be in your account at some point in 2026. Payment, according to the website where you file the claim, will be made by Interac e-transfer or, if requested, by check, and the amount of compensation will ultimately depend on the number of claims. And so the other question, what comes next from a legal perspective? The law firm at the center of the class action says it is still pushing for more accountability. I believe we have a clip from that law firm to play.
We've been litigating for 8 years. It's been very difficult. It's an expensive, protracted, slow process. But we did our best to hold Loblaw's feet to the fire. But to their credit, they came to the table. But the most important thing, in addition to the money, the other really important feature is that we're going to be getting information from Loblaw's in Q1 next year, which we hope will, let's just say, bolster our cases against the other alleged co-conspirators.
Other major Canadian grocers, including Metro, Sobeys, Walmart, Canada Bread, and Giant Tiger, were also accused of price fixing during the time frame of the suit, Andrew. They have all denied involvement. But bottom line, for residents, people like you and me who bought bread over the last 20 years, the deadline is today to be part of this class action lawsuit settlement.
And that was CTV's Scott Hurst. Well, is there more upside for gold in 2026? We'll cover stock picks and investing strategies in gold after the break. Well, gold is up more than 60% over the last year, and this next guest says feels there's more room for it to go higher. We spoke with Tom Windmill, portfolio manager at Midas Funds.
There's a lot of news about the geopolitical events, and yes, they do push the gold price around in the short term. But that can reverse just as suddenly as it started, and then the normal offtake from jewelry manufacturers, they don't come in the market when they see prices rise. They like to see things stable, and then they'll come in and buy. So the big factor we think at Midas is the central bank buying from creditor nations. And I think that's going to start picking up here now that we've had a rate cut in the United States, which usually results in the dollar drifting downwards as it results in interest rates and yields on financial instruments not being as attractive anymore. So they'll probably start picking up the pace of gold buying. And I think that's what we're seeing now.
You're in the camp that thinks that governments with big debt loads, and I assume you would include the US there, they actually need inflation to try to keep the burden down.
Oh, right. I mean, what they want to do is pay these enormous debts, over $35 trillion in public debt, down in cheaper dollars. And the way to do that is just to keep making more. The amount of dollars in circulation is up almost a third since the depths of the COVID crisis. There's just a huge amount of dollars sloshing around in the system. And when you have that much, they just devalue. And now you're seeing these rate cuts, even though the inflation rate has not come down. It's a desperate move, we think, at Midas to keep interest payments from becoming such a big part of the U.S. deficit spending. So when you have deficit spending, huge debts, the debtor countries in the world have to start inflating their dollars to make them cheaper. And the creditor countries in the world are saying, wait a second, let's reallocate more of our assets to gold and other precious metals to preserve the value of their foreign currency, their foreign reserves, as you will. So we think we'll see these debtor nations try to get out from under, and creditor nations moving away from those debt instruments into gold. And I think that's a long-term trend.
You don't think it's a great idea, though, buying gold bars as an investment? Costco, of course, has been doing that, as you know, over the past year and more, selling gold bars to the public. But you think that's a bit of an iffy idea?
Well, Costco is a very savvy retailer. So in that trade, I think you want to be a seller. And the reason for that, Andrew, is because spreads are not really understood that well when you're talking about gold. Some of these spreads in the retail world can be 10%. So you need almost a 11% gain just to get back to even. Much better we think, for retail investors, a regular investor, to own the stocks of really well-managed gold mining companies, because they have gold in the ground. They have gold in the process. They have gold everywhere, more than they can mine typically in a good gold mining company for 10 years. So buy the gold mining companies if you want to own gold, and then you get the upside of return on equity, because buying bullion is a negative return on equity, meaning there's an expense in just the insurance, shipping, costs, all that, even before you start talking about spreads.
So you guys have the Midas Discovery Fund, and I noticed Agnico Eagle is a big weighting as of October 31st. It was about 13%. That's a Canadian darling, of course.
It's a Canadian darling, and it's been that way for decades. They've been paying dividends for over 40 years. I think it's the best management team out there, and the current management is really a favorite of mine because they talk about per share returns. You're a shareholder. You want your shares to become more valuable. A lot of mining teams really are talking about making the whole company more valuable, and that's fine. But that it often means the issuance of lots of more shares. So an individual shareholder gets diluted. Agnico is buying back shares, they pay a dividend, top management team focused on per share returns. And even in the euphoric days that we're seeing now in the gold mining crisis, gold mining explosion upward, they are focused on cost control. They're a real terrific group.
I'm just looking at the top holdings as of October 31st. I'm interested to see neither Newmont or Barrick. And in fairness to you guys, I mean, you've got some lesser known names in there, DPM Metals, substantial company, but not among the giants or New Gold. So you're not just buying the index, I noticed. But Barrick or Barrick Mining or Newmont not making the cut in the top holdings anyway.
Well, of course, Barrick has very well publicized problems. You know, after they merged way back with Randgold, they took on all those African assets. Now, to compare Barrick with its assets in foreign countries, we just talked about Agnico. Agnico focuses on politically safe jurisdictions. Why? So, I mean, Canada is probably the best place to mine in the world. It's got an established mining code. Agnico has excellent relations with the First Nations. Every community they go to, they benefit. But they talk about the fact that a gold mine takes 15 years to get your return on capital back. In many of these jurisdictions that Newmont is in and Barrick is in, just when they start to get the returns on capital, the local government takes over. And Barrick has had a horrible time in Mali and places like that. Let's stay away from far-flung companies with multiple time zones, lots of political risk, and let's stick with the really the blue ribbon, blue blood company like Agnico.
Okay, and that was Tom Windmill, portfolio manager at Midas Funds. Andy was speaking to him. Market calls coming up next. Today on the show, we have Ryan Bushell. He is president and portfolio manager at New Haven Asset Management, and we'll be taking your questions on Canadian dividend stocks. Thanks for watching Morning Markets. See you back here on Monday. Have a great weekend.